Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button.
Yeah,
Now let's break down what's happening in the markets today in a clear and simple way.
absolutely.
So, what if I told you the United States is currently spending billions of dollars to win this massive global economic race, but, we completely forgot to build a finish line?
It sounds kind of crazy when you put it like that, but yeah.
Right. Today, we are taking a deep dive designed specifically for you, the everyday American investor. You want to understand the forces moving your portfolio, but,
Yeah,
you probably don't want to need a PhD in economics to get it.
exactly.
So we are taking some incredibly dense global data, and we're just translating it into plain English.
And it is a vital time to be looking at this because the global economy is, well, it's basically undergoing a structural rewiring right now.
Yeah, that's a good way to put it.
When you strip away all the political noise and look strictly at recent analysis and official reports, there are two massive interconnected shifts happening.
Okay, what's the first one?
First, we have the U.S. aggressively rewriting its entire diplomatic playbook under President Trump just to secure critical minerals.
Wow, okay. And the second?
Simultaneously, we have China navigating this highly contradictory economic tightrope. I mean, they are struggling deeply at home, yet somehow they're just flooding the globe with green technology exports.
Man, that is a lot to unpack. Let's jump right into this first shift because, the narrative in the mainstream media often suggests that Washington is somehow just asleep at the wheel regarding China's technological lead.
Right, especially when it comes to electric vehicles or EVs and the critical minerals that power them.
Exactly. But the recent data actually paints a very different picture of the current administration's awareness, right?
So absolutely. The idea that Washington is in denial is, well, it's a complete myth.
Really?
Yeah, if we look at official White House directives from January of 2026, they explicitly categorize the import of processed critical minerals from dominant foreign players as a direct threat to U.S. national security.
Oh, wow. So they are very aware.
Hyper aware. Then, in February, Vice President J.D. Vance actually led a 55-nation summit focused entirely on critical minerals.
A 55-nation summit, that's huge.
Yeah, and they weren't just discussing the weather, they were actively negotiating preferential trade zones and price floors. The explicit stated goal of that summit was to break China's grip on the supply chain.
Okay, I need to push back here a little bit.
Go for it.
If the White House knows we are behind, and they're hosting 55-nation summits to fix it, why does the data show we are still losing ground?
That is the big question.
Okay, let's unpack this for a second. It's like knowing you need to bake a cake to win a high-stakes baking contest, right?
Yeah.
And you go out and buy all the best flour and sugar, but you forgot to build the oven.
Right.
We have the raw materials, but we lack the domestic ecosystem to actually do anything with them.
The oven analogy is incredibly apt, but let's dig into the mechanics of why that oven is so hard to build in the first place. What's fascinating here is that the U.S. is currently hyper-focused on extraction. We want to dig the dirt out of the ground.
Sure, mining.
Exactly. But mining is actually the easy part. The real bottleneck, the missing oven in your analogy, is the chemical processing, the refining, and the manufacturing of intermediate components like magnets.
But why is that middle step so difficult? Why can't we just build a refinery tomorrow with all the capital flowing around in the U.S. markets?
Because refining critical minerals isn't like refining oil. It is insanely complex chemical engineering.
Oh, really? Is that different?
Completely different. You are taking raw ore and using highly toxic acids at extreme temperatures to separate out these microscopic trace elements of things like neodymium or lithium.
Yikes. That sounds intense.
It is. It requires massive amounts of cheap energy, decades of highly specialized metallurgical know-how that, frankly, we simply let offshore years ago.
Yeah.
And you have to navigate incredibly strict environmental permitting.
Right. Nobody wants a toxic acid plant in their backyard.
Exactly. China spent the last 20 years mastering this brutal middle step and absorbing all those environmental costs. We are basically trying to replicate 2 decades of heavy industrial chemistry in 24 months.
Oh, wow. And the numbers really show how wide that gap has become, don't they?
They absolutely do. While we are caught up in permitting and trying to relearn how to refine these materials, China's EV exports surged to $69.6 billion in 2025.
Almost 70 billion.
Yeah, reaching over 150 countries, and that pace is only accelerating. Just in March of 2026, official reports show Chinese auto exports jumped 73.7% year over year.
Wait, 73% in 1 year?
Yep, They shipped out 700,000 units in a single month.
That is staggering. Meanwhile, here at home, the U.S. killed the federal EV tax credit in late 2025.
Which creates a massive compounding problem for the U.S. market. By killing that tax credit, domestic consumer demand for EVs basically immediately slowed down.
Because the cars suddenly became much more expensive for the average American family, right?
Exactly. And the ripple effects hit the manufacturing floor almost overnight. Volkswagen had to pause production of their ID.4 model at their plant in Tennessee.
Oh, I remember seeing that.
Yeah, and even Tesla's feeling an immense squeeze, having to lean really heavily into lower-cost models just to defend their sales volume.
So we are essentially stalling our own domestic transition while the Department of Energy tries to frantically build the middle of the supply chain.
Frantically is the right word.
I know recent reports show the DOE launched a $500 million program in March for processing critical minerals, plus another $3 billion grant program. But, I mean, throwing money at it doesn't instantly create chemistry labs and engineers.
It absolutely does not. The execution speed and cost competitiveness are lagging far behind. Because we lack that domestic capacity right now, the U.S. is being forced to rely heavily on allies like France, Japan, and Australia to handle the intermediate processing steps.
So for the everyday investor listening to this, I think the takeaway here is crucial. When you hear about the critical mineral boom, do not just blindly throw your money at a raw mining company digging dirt out of the ground in Nevada.
Right, don't just buy the dirt.
Exactly. The real power and the real profit margins sit inside that bottleneck. The smart money is looking at the refining companies, the chemical processors, and the intermediate materials producers. That middle layer is where the geopolitical leverage is trapped.
Whoever controls the refining controls the entire market. It doesn't matter who mines the rock if you have nowhere to send it to be turned into a battery.
Which provides the perfect bridge to our next major shift. If the U.S. realizes it desperately needs both raw materials and the processing infrastructure, and we can't spin it up fast enough domestically, where are they going to get them?
They have to look outward.
Right. And that brings us to Africa. According to the research, that is driving a massive pivot. The diplomatic playbook has been completely rewritten by the Trump administration.
It is a night and day transition. For decades, U.S. diplomacy in Africa leaned really heavily on values-based initiatives, broad development, democratic institution building, social programs.
Right, standard diplomatic aid.
Yeah. But recent analysis indicates that the current administration has abandoned that for a purely transactional America First strategy. Everything is now viewed through the lens of securing strategic supply chains.
So transactional meaning, like, we don't care about your local politics.
Yeah.
What can you do for our national security right now?
Fundamentally, yes. In March 2026, the State Department reorganized and created a new humanitarian bureau, but the official directives explicitly excluded social and climate projects.
Wow, just completely cut them out.
Yep. Global official development aid from the U.S. dropped for the second year in a row in 2025. The State Department's budget justifications now clearly state that foreign aid is not an act of charity. It is a tool exclusively for advancing U.S. national interests.
It's a package deal.
Exactly. We provide aid, you provide mineral access.
And we are seeing this play out in real time, aren't we?
Oh, constantly.
Like, Guinea recently signed a 5-year health cooperation deal with the U.S. And over in the Democratic Republic of Congo, they agreed in early April to take in U.S. deportees from third countries.
Right.
And wouldn't you know it, that deportee agreement happened at the exact same moment the U.S. was aggressively pushing for a new critical minerals framework with the Congolese government.
It is diplomatic horse trading at the highest level.
But wait, let me challenge this dynamic for a second. So what does this all mean for African nations? Are they just sitting back and accepting these terms? The U.S. is the biggest financial heavyweight on the planet.
Yeah.
Can African nations really just sit at the negotiating table and push back?
They have more leverage now than they have had in a century, and they are absolutely using it.
Really? How so?
Well, we are no longer in a unipolar world where the U.S. is the only game in town. These nations know that if the U.S. walks away, China or the European Union is standing right there with an open checkbook.
Okay, so how does that pushback actually look on the ground?
Take Zambia as a prime example. The U.S. offered a $1 billion health and development deal. A decade ago, Zambia would have signed that immediately.
Right. $1 billion is a lot of money.
Huge. Instead, they pushed back and demanded revisions because the draft text explicitly linked the health aid to mining cooperation. They refused to be bullied into a mineral concession just to get medical funding.
That is incredible. They are reading the fine print and calling our bluff.
And they are finding their own financing. You mentioned the IMF and World Bank earlier. Well, the Congo bypassed them entirely in April 2026.
How to do that.
They issued their first ever international bond, raising $1.25 billion directly from global capital markets. By securing their own independent funding, they publicly threatened to find other international partners if the U.S. mineral framework doesn't result in real, tangible infrastructure projects inside the Congo.
So they don't just want us to buy their dirt. They want us to build the oven in their country.
Precisely the dynamic we discussed earlier. Zimbabwe might be the most aggressive example of this. In April, they resumed their lithium exports, but with severe conditions attached.
What kind of conditions?
They demanded that foreign companies build local lithium sulfate factories on Zimbabwean soil, and they instituted a hard ban on all raw mineral exports starting in 2027. They are forcing the refining process, that lucrative middle layer, to happen locally.
Wow. So if a U.S. company wants Zimbabwean lithium, they have to invest millions building a chemical processing plant in Zimbabwe first.
Exactly.
That is a massive shift in power. And the U.S. isn't exactly operating from a position of strength in the region right now, are we?
Far from it.
Yeah.
U.S. structural weaknesses in sub-Saharan Africa are glaring. Recent reports highlight that U.S. embassies across the continent are severely understaffed. We recently lost a critical military base in Niger, which diminishes our security footprint.
That's a big deal.
Yeah. And the macroeconomic environment is tough. The World Bank downgraded sub-Saharan economic growth to 4.1% for 2026 due to global energy shocks.
So if you are an investor looking at emerging markets, you have to realize Africa is no longer just a dot on a map where superpowers extract cheap resources.
Not anymore.
It is a highly competitive, sophisticated negotiating table. The future winners in African investments are not just the mining operators. The real winners are the heavy construction and engineering firms building the local infrastructure, the deep water ports, the heavy haul rail lines, and the industrial power grids. Because without that infrastructure, you can't build the processing facilities that these governments are now legally demanding.
It comes back to value capture. African nations are finally enforcing policies that ensure the economic value of their resources stays within their borders.
Okay, so the U.S. is aggressively changing its global strategy, scrambling to build domestic processing while negotiating hard in Africa, all specifically to counter China's dominance.
Right.
But if we pivot and look at the official data coming out of China right now, their own economy is painting a very confusing picture.
It is an absolute paradox. If you read the headline numbers, you might think China is recovering. According to official data, China just escaped a grueling 41-month streak of deflation.
Wow, 41 months.
Yeah. In March 2026, their producer price index, the PPI, finally ticked up by 0.5%, and their consumer price index, the CPI, went up by 1.0%.
Let's break down why this is a paradox, because understanding inflation is critical for anyone managing a portfolio. Here's where it gets really interesting. Normally, when you hear inflation, you picture a booming economy. People have jobs, their wages are up, and they're rushing out to buy things.
Good inflation.
Right. Because demand is so high, businesses can raise their prices. That is demand-driven inflation. But what is happening in China right now is what economists call cost-push inflation. And it is a totally different beast.
It is a much more destructive economic force.
Think about it like your local neighborhood coffee shop. Suddenly, the owner raises the price of your morning latte from $4 to $6. Now, they didn't raise the price because there's a line out the door and they are super popular.
No line at all.
Right. They raised the price because the global cost of raw coffee beans just skyrocketed. The shop owner is actually making less profit per cup, even though the price on the menu went up, and you, the customer, are angry about paying more. That is cost-push inflation.
That analogy perfectly tracks the Chinese data. The 1.0% rise in consumer prices isn't being driven by domestic Chinese citizens feeling wealthy and going on shopping sprees. It is being driven entirely by external global energy shocks.
Like what?
Specifically, rising oil and raw material prices linked to the ongoing conflict in the Middle East. The cost of keeping the factory lights on just went up.
And we can see the cracks when we look at the broader economy.
We certainly can. The official manufacturing index, the PMI, is barely holding above water at 50.4. But the service sector, the part of the economy driven by everyday people going to restaurants or traveling, is actively shrinking. New domestic orders for goods are falling.
So the coffee shop doesn't have a line out the door, but their costs are surging. How are Chinese businesses handling that?
In highly competitive sectors like solar panel manufacturing or the domestic auto industry, they are trapped. They are facing higher costs for raw materials due to the energy shock.
But they can't raise prices.
Exactly. Because the domestic Chinese consumer is financially exhausted and hoarding cash, these companies cannot pass those higher costs onto the consumer. If they raise the price of a car, nobody buys it. So the companies are forced to eat the higher costs internally, which is absolutely devastating to their profit margins.
In a normal Western economy, if the consumer is tapped out and businesses are hurting, the central bank steps in. They cut interest rates to make borrowing cheaper, which usually stimulates spending. Why isn't President Xi Jinping doing that?
Because Xi Jinping is playing a very different macroeconomic game right now. Major global investment banks have actually withdrawn their predictions for massive interest rate cuts in China. The Chinese government is intentionally refusing to flood the broader economy with cheap money.
Why? Wouldn't that fix the domestic pain?
It might temporarily fix consumer spending, but it would inflate another massive real estate or debt bubble, which they just spent years trying to deflate.
I see.
Instead, on April 6th, President Xi Jinping announced a focus on accelerating a new energy system to weather global storms. The central bank is using highly targeted liquidity.
What does that mean in practice?
They're using a precision laser to funnel money strictly into advanced manufacturing, green tech, and export-driven sectors, completely bypassing the average domestic consumer.
Which leads us to the most fascinating dynamic of this entire deep dive. If Chinese consumers aren't buying things, but Chinese factories are still churning out record numbers of solar panels, batteries, and electric vehicles thanks to this targeted government cash, where is it all going?
It's flooding the rest of the world.
Right. It has created what analysts are calling China's dual-track economy. You have a domestic bust and an export boom happening simultaneously.
Based on the analysis, it's a stark divide.
Walk us through the domestic bust first. How bad is it inside China?
It is brutal. The domestic auto market is in a deep freeze. In March 2026, auto sales inside China dropped 15.2%.
Wow.
And that is the sixth consecutive month of decline. When you have a half-year trend of double-digit drops, that is a systemic issue. Even massive homegrown giants like BYD are seeing their domestic sales fall. Mercedes-Benz recorded a staggering 27% drop in their Chinese sales for the first quarter.
That's a massive hit for Mercedes.
Yeah, and Tesla is caught in the crossfire too. They are relying heavily on pushing their lowest cost models just to maintain market share, which is severely compressing their margins. It is a race to the bottom on price.
But the export track is the exact opposite.
Externally, China is an absolute juggernaut right now. As we noted earlier, their auto exports surged 73.7% in March alone. BYD isn't worrying about their domestic slump because they've set a target to sell 1.5 million vehicles overseas in 2026.
There is a wild irony here. The same global energy shock and rising oil prices from the Middle East that are causing China's painful domestic inflation are actually acting as rocket fuel for their exports. Well, if you are a country in Latin America or Southeast Asia, and the price of imported oil suddenly shoots through the roof because of geopolitical conflict, what do? You desperately look for ways to get off oil.
Right.
Suddenly, cheap electric vehicles, solar panels, and grid-scale battery storage become incredibly attractive. You need an energy transition. And China has the manufacturing base already built, scaled, and subsidized to sell you that transition cheaper than anyone else.
That is the exact mechanism driving this boom. China is exporting deflation in green tech to the developing world.
But they aren't exporting it to the United States.
No, and geopolitics is the hard wall they keep hitting. The U.S. government is actively fortifying the market. The U.S. Trade Representative reaffirmed strict rules on April 9th, effectively blocking Chinese vehicles from entering the American market over data and security concerns.
And we should clarify why that blockade exists. It isn't just about protecting Ford or General Motors from cheap competition. Modern EVs are essentially giant rolling computers.
Exactly.
They map streets with high-definition cameras, they track civilian movements, and they sync with personal cell phones. The U.S. views a fleet of millions of Chinese-made, internet-connected vehicles driving around American cities as an unacceptable national security and data privacy threat.
Exactly the justification used by the USTR. So the U.S. door is firmly locked.
So if the American market is closed and the Chinese domestic consumer is tapped out, this massive tsunami of manufactured green tech has to flow somewhere else.
If we connect this to the bigger picture, It is following the path of least resistance. China is pouring these exports into Europe, Southeast Asia, the Middle East, and Latin America. They are systematically finding every single market that isn't locked down by U.S. security tariffs and absolutely dominating market share.
Let's bring this all together for the beginner investor listening right now. When you open a financial news app and see a headline screaming about a Chinese EV company manufacturing 1 million cars, you need to look past the top-line number. You have to ask, where are those cars being sold, and what are the actual profit margins?
Because of the ruthless price wars inside China, a company might be selling hundreds of thousands of cars domestically and actually losing money on every single transaction just to keep the factory lines moving.
Right. So just like we discussed with the U.S. supply chain and the African infrastructure boom, the smart money here isn't necessarily betting on the final consumer brand fighting a bloody price war. The stability lies in the middlemen.
The middle layer again.
Exactly. It's the companies manufacturing the internal battery cells that all the car brands use. It's the grid infrastructure companies building the charging networks in Brazil or Thailand. It's the overseas logistics and distribution networks moving this product into Europe. Those middle layers have the pricing power, and they are generating steady profits while the automakers fight for survival.
It requires a shift in how we analyze these markets. You have to look for the indispensable components of the supply chain, not just the shiny product at the end of the line.
We have covered a massive amount of ground today, so let's distill the core lessons for you, the listener. If you remember one concept from today's deep dive, make it the middle layer.
For sure.
The entire global economy is currently obsessing over the middle of the supply chain. The U.S., under the Trump administration's America First policy, is realizing it cannot secure its future just by mining raw materials. It desperately needs the middle layer of chemical processing and refining.
Meanwhile, African nations understand this exact same dynamic, and they are using their immense leverage to demand that the processing infrastructure is built on their soil, not exported.
Right. And over in China, while the domestic consumer is frozen, factories are flooding the non-U.S. world with green tech, making the middle supply chain components the safest harbor for capital.
It is a complete realignment of global value capture, and it leaves us with a critical, long-term question to ponder. For the last 30 years, the world enjoyed low prices because everyone shared the exact same hyper-efficient global supply chain centered in Asia.
With globalization.
Exactly. But if the U.S., African nations, and European markets are all simultaneously demanding that processing, refining, and manufacturing be duplicated and contained strictly within their own sovereign borders, what happens to the price of everything when the world stops sharing the same supply chain? Decoupling is not going to be cheap.
That is a million-dollar question and something we'll be tracking closely as these policies collide in the coming years. Don't forget to subscribe and hit that like button.